Tony, welcome back to the show.
Tim, thanks for having me. Great to see you.
Really excited to have you back. Always appreciate your perspective on a topic that I know is top of mind for many in our community, which is financing a home purchase. And, for some, that might be a first-time home buyer. For others, that might be the second or third home, or there might be investors that are listening as well. And this episode is really intended for the buyer at large, not necessarily any one of those specific groups, but for those that are wanting to learn more about financing a home or investment property purchase here in 2026. We'll talk a little bit about the current market, kind of what you're seeing out there in 2026, what you expect maybe for what the rest of the year holds for us. And then we'll talk about an exciting update that First Horizon has on a new product that I think our audience will be interested in, which is the medical professional loan. So more to come on that. But first, Tony, for those that maybe haven't heard you on the podcast over the last 5 or so years, why don't you give an introduction to who Tony is and First Horizon?
Well, thank you again, Tim. And I always have fun being on this podcast with you. We're in springtime. It's a great time of year, and at least we're moving into spring most part of the country. But I've been in this business now a long time. I'm pushing 24 years in the mortgage business, and I've ran teams. I have an excellent team that works for me as well. It's been with me a long time. And, our focus is on originating residential loans. So we help people buy their home, the home that they live in, or an investment property, or a second home. And so it's going to be 24 years in October, Tim. I can't believe it.
That is wild. And even just thinking about the past 5 years that we've had a chance to collaborate, and the benefit that that's provided to our community and those that listen to the podcast. So excited to hear kind of what you're seeing out there in the market. So let's start there. 2026, feels like every year, maybe since the pandemic, it feels like every year has just been a wild ride of like, what is going on in the housing market? What are we expecting to see the year come? What's going to happen to interest rates? What's the Fed going to do, in terms of rate reductions? What might be the impact of that on those that are looking to purchase a home in 2026? So big question, lot to unpack there, but what are you seeing right now in kind of spring 2026 in the market, and what you feel like lies ahead for the rest of the year?
You said it. There's just so much volatility. There's so much change. But I'll give you guys kind of a high level of what we're seeing. Obviously, the war in the Middle East is causing a lot of volatility in the stock market and the bond market. So rates have
Yep.
they're still a little bit better than they were last year, but we've seen them rise since January. So rates were actually very attractive in January. We saw some of the best rates we've seen since 2023. So it was 3 years. We saw some of the best pricing we'd seen in January of this year. They've come up with the expectation that oil prices are rising, right? So anytime you see oil prices rise, traditionally the 10-year Treasury note will rise. So that kind of pushes rates up. Again, this morning even, we had, as at time of this recording, oil prices are pulling back, rates are improving a little bit.
Yep.
So I think there's just going to be a little bit of volatility as we go on here. But overall, I think rates are in a better position than they were than in 24 and even parts of 25. They're in a better position, and definitely better than 23. 23 was the peak year.
Mhm.
The good news that I see for buyers is, and we're seeing more activity this year than we did last year, Tim. It has definitely
Mhm.
picked up for us. A lot more people looking. I'm seeing more people getting out there. The good news is there's more inventory in most markets around the country. So buyers are in a position where there's more to choose from. Sellers are more flexible with their terms. We're seeing more contracts coming in, and the buyers are able to get a little bit better pricing, which is excellent. We didn't see that during COVID. We didn't see that in those 2 years after COVID. I think if you recall, a lot of our buyers couldn't even get inspections done. It was crazy. So now it's at least
Yep.
calmed down in that regard. Insurance premiums, it's funny. I've seen them coming down a little bit. They were peaking for a long time and continuing to rise. And we're starting to see them come down a little bit, especially I'm down in Florida is where I'm located. Obviously we lend across the country, but Florida's known for high insurance premiums, probably some of the highest in the country. And we're starting to see them ease a little bit, which is big. That's really big for people. So, overall, there's a lot of good things happening. I think there's certain sectors that have been getting hit harder than others. As far as industries, some that are exposed to AI are certainly getting impacted.
Yeah.
So, you know, overall, I think in the long run, I think rates will trend down. There is a chance rates go up this year if we continue to see inflation due to oil prices rising or just overall economy being fairly healthy. I mean, some of these economic reports are still pretty healthy, and that's driving a little bit of inflation. Although I don't see runaway inflation, I really don't. Oil prices, if they stay high, could bake in a little bit more. But the Fed, it's going to be volatile. I think the Fed has at least one cut this year. That's what they put in their dot plot that was out
Yeah.
last week. They did have a cut this year, but I could see rates really collapse if we start seeing. You see any job loss, guys? Rates are coming down
Mhm.
fast. So, and one thing that I'm watching, and your audience primarily, they're in really good positions because pharmacists, physicians, these are things that are
Healthcare.
AI proof, right? They're AI proof.
Yeah.
You can't say that about a lot of white collar finance jobs, insurance jobs. There's a lot of things, accounting, attorneys, that I think is going to impact the industries. So that could affect those and cause some initial job loss that could overall help interest rates. Unfortunately, it's deflationary, right? When we see job loss. So in the near term, I'm positive about the housing market. I think things are steadily getting better, and I think it's a better time for buyers. It's safer now because you've seen prices ease a little bit, and you're starting to see more inventories.
Yeah, and I think it's interesting, Tony. I'd love to get your thoughts on this. And I'm not trying to suggest that I, understand the ins and outs of this or in any way predict, what's going to happen to interest rates as a result of this. But as you mentioned, the AI piece and potential impact on employment numbers, and as we see potential rises in unemployment, we'll certainly see, right, as you mentioned, an impact that will come on lending, including rates on buying a home. And everything I've listened to and read in terms of the impact of AI or potential impact of AI on jobs talks about this kind of lag effect where, there will be a short-term positive impact economically as we see improvements in productivity that happen from companies using these. Profitability of companies may go up near term. How long is that, I think, is the question, right? And then lagging behind that would be the impact of the job loss that comes, secondary to that. And so it's just such an interesting time, economically. And even the volatility you're speaking of, the thought that came to mind as you shared that was like, all the more important to have a good relationship with the lender when we're talking about financing a home purchase, right? Because this stuff is moving so quickly. The example you gave in terms of the oil prices and the changes we're seeing, even here at the start of the week on recording this episode, that has shifted dramatically in the last 48 hours, largely based on some remarks, right, from the president. That's just a reality of where we're at in terms of the time period. And so understanding, like, hey, am I working with a lender who's kind of, has a good pulse, relationally can help me? And if I'm in the midst of potentially buying a home and locking a rate, and you see things moving quickly as they are, like, hey, maybe this moment is the time we want to lock a rate, right? Because 48, 72 hours, we might see shifts and changes that happen the other way. And so I think the lender relationship piece to me really stands out, given the volatility we're in and the changes that are happening economically and how quick they're happening, right?
Yeah, very quickly, and you gotta keep on the pulse, like you said. There's a lot of change quickly, and one thing I do tell clients is once you lock a rate, you're not going to see the rate go higher, and there's only certain times I recommend floating when we really see an environment like when we were going into COVID, right? We knew we could see the deflationary signs, but in this environment, it's just so much volatility. So it's very
Yeah.
hard. And I'm so glad we locked most of our pipeline before this, before this oil spike. So it's
Yeah.
been, that's been cool, but you're exactly right. And but I don't want to scare people because like I said, I feel like that And every part of the country is different. I've said this before. Certain parts of the country may not have as much inventory, but
That's right.
overall, we're seeing more. And that's a good thing for buyers. That means you can negotiate, you can find things, get a better price than you could before. And like I said, rates are still, even after the most recent run up here, they're still better than they were on average last year. So you're still in a better position. And
Yeah.
and
Yeah.
part of that reason, I don't want to get too technical. I have said I'm a bit of a finance nerd in the past, but one thing is the spreads above treasury bonds, the mortgage-backed securities that how mortgages are priced, those spreads have come down. And that's why rates have been better. 10-year treasury really hasn't improved, but those spreads have narrowed. And that spread coming down is what's allowed us to give, better pricing this year versus last year.
Tony, I want to shift here and talk about the financing of a home. Again, whether it's a first-time purchase or second or third, what buyers need to know and to spend a little bit of time in a few different areas, including just a general overview of financing or loan options, things for them to think about in terms of getting financially prepared. So how do they get ready to work with a lender, credit considerations, and then we'll talk about down payment strategy. So let's start with the loan options overview. I think some are probably very familiar with the suite of options that are available, especially if they've been through the home purchase. But for others, this might be the first time they're going through it, or they might have found themselves, even on a first-time home purchase, they might have found themselves in one financing option without necessarily being aware of what else was out there. And so talk to us at a high level of the different options available to the buyer when it comes to financing a home, whether that be a conventional loan, an FHA loan, a VA loan, and just what are some of the key differences between these?
Yeah, great question. And one thing, obviously, we always look for the best product to fit the
Yeah.
individual's needs. There's always, you never know. Sometimes FHA is a good product. If your credit score is in a certain space, your loan size is a certain amount. So there's a lot of different options. So your main three that you'll hear is conventional financing, FHA, and VA financing. So VA loans are only for, veterans, right? Or active military. So you have to have VA benefits to be eligible for that program. FHA loans are capped in every county in the country. So each county in our country has an FHA loan limit, meaning the highest the loan amount will go. Some counties is 550, some it might be 700,000. So it'll vary depending on the county. What I like about FHA is it's flexible if you have lower credit scores. So if you have a 640 credit score, you're going to get a better interest rate with FHA than you would with a conventional loan. What I don't like about FHA is the PMI is very, very high, and you
Yeah.
can never get rid of the PMI for life. It's on that loan for life until you refinance or sell that home. So there's pros and cons to all programs. And then we have some niche programs that would probably fall under the conventional side, but they're not through Fannie Mae or Freddie Mac. And some are for special positions like a pharmacist, a doctor, an attorney.
Mhm.
And you're basically eligible to do these loans with very little to nothing down with no mortgage insurance. So traditionally, if you get a conventional home loan, and you don't put 20% down, you'll have to get PMI. You'll have to pay PMI. And what mortgage insurance is, it's to protect the lender on anything above 80% that's owed. So if you default on the loan, they're protected on that balance. So if you buy a $500,000 home and there's a $100,000 down payment required to avoid PMI, and you put 5% down, well, that difference, that $85,000 difference is insured through those PMI premiums. And that's how PMI works. And conventional loans require PMI. And sometimes PMI is okay, depending on your loan to value, but we try to avoid it if we can,
Yeah.
especially if you're in a position where you can avoid it. So those are the primary products. There are, there's different, I don't know how technical we want to get, Tim, but there's different requirements for each one. And
Yeah.
we just, again, try to look at the borrower and see what's best for them.
And I think that's the key point. You and I were even talking about that before we hit record, right? That, there's some great options that are out there. We'll talk about one here a little bit with the medical professional loan. But at the end of the day, everyone's situation is different. The goals of what they're trying to achieve is different. Their credit score is different. Their ability to come up with cash for a down payment is different. The amount that they have available for reserves, if that's required, is different, right? So all these things are going to factor together. And you might go in as a buyer and think, hey, this option is best for me. And maybe it is, but just given where the products are, your situation, where rates are, it may be something else. And we've talked about that before. And so I think that lender relationship is really important to know that, hey, we're going to look at the variety of options that are out there and find the one that is best for this situation. And what I really hear there that I think is going to be of most interest to our listeners is the significant differences between a conventional and FHA, a VA, or even some more of these niche options in the percent that's down, right? So most home buyers I've talked with, especially first-time home buyers, there's a general assumption that, hey, I've got to have 20% down. Or if they've maybe, gone a layer deeper, they recognize that, hey, I have another option and something like an FHA loan that won't require 20% down, but then I've got to deal with PMI and some of the challenges that are there. And I think the message we're trying to convey here is there's probably a lot more options than folks are aware of. And that 20% down, I have seen this, Tony, over and over and over again, is a significant barrier for many people buying their home. It always has been, but given where home prices have appreciated, it certainly is more than now than it ever has been. So just for some, round numbers, if someone's looking to purchase a $500,000 home and it's a 20% down payment requirement on a conventional loan, they've got to have $100,000 in cash, right? Plus they've got to have any type of reserves if that's a requirement for the loan type. And that's just hard. That's hard if you're trying to pay off other debt like student loan debt, or even if you're beyond paying off student loan debt, life expenses, saving for retirement, all these other things. It just can be difficult to come up with the cash to do that. And so I think really evaluating those options, understanding which of them may be best for you, and then again, working with that lender to identify the product relative to the goals. And let me also just give a shout out. I was talking with a group, Tony, last week on the East Coast in the New Jersey area. And if I were to give the example of, hey, you buy a $500,000 home, they'd be like, I wish, right? And our friends here in Ohio would be like, hey, I can get a pretty nice home, in Ohio for $500,000. So, depending on where you are in the country, we were talking before we hit record that, hey, if you're in the DC area or Northern Virginia, or you're out west on the coast or in the Northeast, like we might have to look at some different products just given the size of the loan, right? And the realities of purchasing a home in those parts of the country. Another thing I wanted to get your input on here, Tony, when we talk about loan options, financing options, a common question I get is just fixed rate versus adjustable rate mortgages. And how should I be thinking about that as a prospective buyer? And I know this is a moving target, of course, it's depending on where rates are at, but your general thoughts on fixed rate versus adjustable rate financing options.
Well, so there's multiple fixed rate options. You have a 15-year fixed, a 20-year fixed, 25 and a 30. The lower the loan amortization, so a 15-year fixed is always going to have a higher monthly payment because you're paying the loan off quicker. So you pay a lot less interest with a 15-year or 20-year fixed, but the payments are higher. The adjustable rate mortgages are not the adjustable rate mortgages that we saw 20 years ago that were, moving with the market day one. They're really a hybrid loan. And what I mean by that is they're fixed for 5, 7, or 10 years. So you've got a fixed rate for 5, 7, or 10 years, and it's on a 30-year amortization. And what that does is traditionally will give you a lower interest rate than a 30-year fixed. So that 5, 7, or 10 year will give you a lower rate than the 30-year, and you get better pricing. And again, you've got 5, 7, or 10 years before it'll adjust. And then at that point, it can adjust. It can adjust. Typically depends on the type of arm. Some are annual adjustments, some are semi-annual adjustments. And then there's caps on those rates, meaning they are capped at, 2 or 2.5% or 2.25% above the start rate year one. And traditionally they all have a lifetime cap too. And typically that lifetime cap is 5%. So 5% is typically what you see as a lifetime cap. I will tell you, we get a lot of demand for those arms, Tim, and especially people who have bought before, because they know, hey, I'm not going to have this loan I mean, my overall take is I think we'll see interest rates cycle over 5 to 7 years, 10 years especially. You'll probably get entry points to refinance. We already saw that. Not too many people acted, but
Yep.
we had some refinances in January.
Right.
We did in August of 2024 when they went down, for 1 week, and we were able to save people some money. You got to move quick in this environment, but you're going to see dips. So I think as you see dips, you can take advantage of that and lock in 30-year loans. Crazy thing, we don't have this anymore, so I'll say it. But at one point in January, we locked some 15-year fixed loans under 5%. So high fours, 15-year fixed. So that was a couple months ago. It's not there now, so we can't get excited about it. But my point is they dip, right? They move. So over time, you'll see opportunities. So I typically feel pretty good about the ARMs. And then also the average homeowner is typically not in the home more than 7 years anyway.
Right. Time.
It's just that's the averages. So if you're likely to move, that's why they're attractive to some people too, because they think they're only going to be there for a set amount of time.
And again, Tony, relationships, right? What I'm thinking of as you're talking is, hey, if I've worked with Tony and his team before, to buy a home, and I'm, interested in refinancing potentially if and when that makes sense, but I don't want to watch this every single day or think about it. Like, hey, Tony, like keep me in mind, right? For when it may make sense. Would you mind reaching out to me and kind of giving me a heads up? So I think the relationship piece is so important. For those that have gone through this process before, Tony, they know that you got to have your ducks in a row in terms of, we got to submit proof of income. For most pharmacists, that's going to be W-2 income. For others that are self-employed, that might be a little bit more nuanced. We got to submit tax returns, right? We got to submit proof of reserves and other types of accounts. So there is a step. Now, I think many of our listeners have their financial house in order. If they're listening to this podcast, they probably already have a lot of these things ready to go, or at least can quickly get them ready to go. So I don't think this is moving mountains for many people, but it does take time, and it takes time to get all that together. And especially if you have self-employed income or other types of variable income, or you haven't been in your work for a long period of time where it's been a time period of stable income, there can be some wrinkles here in terms of the lending process. So what are thoughts that you have for prospective buyers just on timeline to kind of be thinking about of getting all these things together? Because we know how this goes. We've talked about it before. Like, hey, I'm thinking about buying a home in the next year or two, and then all of a sudden we're out looking and I want to buy tomorrow, right? It can move pretty quickly. And we want to make sure that we have our documents ready to go and we have our lending ready to go. So thoughts on kind of timeline and working with a lender and getting all of this prepared?
Well, I never think it's too early if you're actively looking, if you're taking the time to look. I think it's important to know your price range. I think it's important to have that conversation. Do you really need to have a full credit pull? Do you need to have everything analyzed? Maybe not, but at least your income analyzed and an idea of what your debt to income ratio is, because time is valuable. You want to know what range you're in. Even if you're just doing like an internet search to start. If you're working with a real estate agent, in many parts of the country, they will not take you to a home, nor will the listing agent who's selling the home for a seller will allow you in the home without a pre-approval letter. I know that happens a lot. They'll want that letter before you go looking for homes. Many parts of the country, that's standard practice. So you'll need that before you actually go get in the car. So I would say, pre-approvals are good for 90 days. This is a good question, Tim. They're good for 90 days. It's very easy for us to update them. But I don't think it's ever too soon if you're spending time looking, because you want to know what price range you're in. And it's interesting, since the beginning of the year, I had several people call, we're looking to be about 9 months or so. Well, guess what? The house they really like popped up and they're under contract already. So when you find what you want, you sometimes need to move. And we've had several of those conversations at the beginning of the year where we were projecting, I even said, hey, call back in June or May or whatever. No, we found what we want. We need to move on this. So things change quickly. I just think when you guys know you're serious and you're ready, I think it's good to know where you stand, because we have some situations where we need credit scores a little higher. Well, we can help give you some ideas to improve your credit, and get a little bit better rate or qualify for more. Or there could be a way to get your debt to income ratio more in line.
Right.
It's important to keep that debt ratio in line. Debt to income ratio is extremely important. I would even say it rivals credit score. It's probably the
Credit.
most
Yep.
important thing. You got to show the ability to repay the loan. That is a mandate by our governing bodies for lenders, is to show the ability to pay that loan. So that's a great, lenders can give you that feedback. Okay, your debt to income ratio, that's the ratio we look at. It's 40% or it's 50% or it's 60%. Well, if it's over 45, it's generally considered a little high. We have products that will go to 50% for certain situations, but we want to keep that below 45 if we can. And that'll give you more margin to invest, more margin to save, which is very important.
And we're looking, Tony, at that just so our listeners understand, because I think it's relevant whether it's the first time or they're going through it again. We're looking at gross income relative to
Yes. Yes, Tim.
all liabilities, correct?
Yes. Yeah, that was a great point you brought up. Yes, it's gross income. It's gross
Okay.
income. And just to expand a little bit on what you said in the beginning on this topic, W-2 income, very easy to document. Some of our products don't even require tax returns if you're W-2'd. It's literally pay stubs, W-2, and that's it. But if you're self-employed, you're going to have to provide tax returns. Depending on the type of self-employment, we may need corporate returns if you have an S Corp. So it is more complicated if you are self-employed, but it's definitely something that can be done. We work with those buyers all the time, just more paperwork. Or if you have a side hustle that's producing income or something like that, we need to see that as well if you have like another business on the side. So that's when tax returns will be needed.
And considering debt to income is so important, I'm thinking about our listeners, typically really good, strong W-2 wages, often, not always, but often we'll see two strong W-2 incomes in a household. So I think the income side is usually pretty good. But
Yes.
when it comes to the debt to income ratio, student loans, you might have two strong incomes in the house, but you might have combined, $300,000, $400,000 of student loan debt, especially if people are a little bit earlier in their career. So to that point, how does the lender, given all the changes that are happening, right now around student loan payments, and you and I were talking about some of these offline before we hit record, but how does the lender assess their student loan liability when it comes to their debt to income ratio?
Really good question. So it's going to depend on the programs. So which program we're looking in. So for example, FHA conventional, they're not super lenient with the student loans. So like if you're in deferment, let's say you're not making any payments, most of the audience is probably making an income-based payment, but let's say you're not. So we have a few, especially on the resident side with physicians, we see this more often, but there's factors that are used. So if let's say you owe $200,000, and typically conventional requires a 1% factor. Well, that's $2,000 a month. It almost eliminates that person's chance of qualifying, right? So these traditional programs, FHA, conventional, are very difficult. We do have some other products that are like, we have our professional loan program that goes up to 832. That has a 0.5% factor versus 1 for conventional. That's still $1,000 a month, right? 0.5% of 200,000 is $1,000 a month factor. So, and then we do have some programs that more for the physician side are 0%, so it won't count it at all. But I find that most of them are income-based type repayment plan. And if someone needs that, we advocate you to get the letter for us, so we know what that payment's going to be. Because typically that's going to be a better way to qualify versus the factors.
Yeah, and this is a great example, Tony, without going down the student loan rabbit hole. I was speaking with a group last week, and a common question I'll get, especially for those that are maybe in like a training period, residency fellowship, is, what are the pros and cons of deferring my student loans, right? Because, what they're looking at, for good reason, which is understandable, is, hey, I'm in a lower income earning season of life, and therefore, there's not margin, right, for student loan payments. And kind of the next level to that question is, well, can we analyze this a little bit further? Because it might go beyond just the student loans. Here's a great example, right? If you can opt into an income-driven repayment plan, and we can work that into the budget because, we're looking at your previously reported wages when it comes your adjusted gross income to come up with that monthly payment, it might be a lot more affordable than you think. And that puts us into active repayment and doesn't default us to maybe some of these general rules of thumb like it might on the lending side, right? If we're buying a home, which often does come up for people in that season of life. So just a really good example in the overall financial plan of where it depends. It depends on kind of what else is going on and making sure that we're not looking at it in a silo and understanding, what are the ramifications of something like deferment or what are the pros and cons if we go that pathway. Since you mentioned credit, debt to income ratio, you mentioned could rival credit. We talked a little bit before about the credit scores and some of the products that are available for scores that are sub 700, therefore suggesting that, hey, if we have a stronger credit, obviously that's going to have more favorable, financing terms. So I think building credit, understanding credit, doing everything we can to improve our credit position is something that a prospective buyer wants to do. My question for you here, though, is any big common credit blunders or mistakes that you see people making that our listeners could avoid if they're a prospective buyer?
The first thing I would say, obviously make all your payments on time, everything on time.
Yeah.
Never, I find with credit is if you have the drive to fix things that are wrong, like let's say the student loan servicer said you were late when you weren't, and you have proof, fight it. Make sure you get that off there, because that drive to clean it up and keep your credit where it needs to be is going to be very valuable later. But one of the biggest blunders I see, Tim, and this is with very young, educated people, is not just young, older too. And I went through this myself when I was in my early 20s, is we walk in to buy furniture. I've told you this before, or a TV set or whatever it might be, right? Whatever it is, whatever furniture store or electronics store, and they offer you a credit card and say, you don't have to pay this back for 1 year, right? And let's say you put $5,000 on your card for a couch and a coffee table and all this. Well, what it does is basically a maxed out credit card on your credit report, and it'll hit you for 30 or 40 points. And I've seen that over and over again. I myself did it back in 2003 or 4, I think it was 2003. So I've done it. We've done it before. I learned my lesson, but I see that a lot. So just be careful with that, because it'll show up as a maxed out credit card, and that'll segue into your credit cards, right? Manage them well, because most people that are in your profession, Tim, and this are responsible, right? And they're making their payments on time, but they don't realize that these credit cards, they have a $10,000 balance, they run it up to $9,000. It's going to hit their credit a little bit that month until they pay it down. So I think that's one of the most common that I see outside of missed payments is running the credit card balances up or buying something on credit that's a maxed out card, even though financially not paying interest for 1 year is attractive, right? Anyone, hey, you can buy this TV or whatever, but it does show up and it does penalize your credit report. The other misconception I get too, a lot of people think inquiries are going to really hit their credit hard, and it just doesn't happen that way. They're the least impactful. Okay, you don't want a lot of inquiries on your credit report. You don't, not advocating for that. But what I hear is people are very worried that having 1 or 2 lenders look at their credit is going to impact them. The answer is really, it's not at all, because you're allowed a window to have a few people look at it. Where inquiries can hurt is if you're getting a multiple types of credit at one time, and it's going to be a fraction of the effect of a high credit card balance, but you can get a couple points off if you go to Dillard's or department store and you apply for a couple credit cards, you're getting a mortgage loan, you're getting a car loan, and you do all these inquiries at one time, or the car company, auto company, has your credit run by like 10 different people because you sign a form, or you go to one of these online lending platforms and you authorize mortgage brokers around the country to run your credit, which is Most people know not to do that, but I still run into that sometimes. And what it is, they run it so much that it can impact you. So
Yeah.
it's a misconception to have a couple, but the main thing would be your credit card balances, payments on time, and just managing the amount of inquiries for the types of credit. Okay. Those would be the main things.
Great stuff. And as we've talked about this topic before, I think for the prospective buyer, just think about it as if you are the one lending money out, right, to yourself. You want to see stability, not only strong credit, but you want to see stability. You don't want to see a lot of changes that are happening, especially around the timeline of these financing decisions happening. So stability, I think really important as you're going through this
Stability and the
process.
ability to fight, like I said, with there's a collection file that wasn't accurate. I've found this where people weren't really responsible, but there was a mistake and they just never
Yeah.
followed through. So that ability, that gumption to follow through is going to pay dividends later,
Mhm.
So you just got to protect your credit, even if something's a gray area or wasn't correct.
Yeah, credit reminds me of tax, right? It's just like a thread throughout the entirety of the financial plan. Not super exciting to think about, but we recommend, hey, run a credit report once a year. Set it on your calendar. My partner Tim does it when the clocks, change each spring. Like, find the rhythm that works for you, but just a part of that overall financial health and checkup to make sure like there aren't any, delinquent. And there's a lot of technology and tools now where you can identify these a lot quicker. It used to be a much more manual process, but good thing to be tracking your overall credit health, credit report, making sure we're identifying and fixing errors as quickly as we can. Tony, I want to wrap up and talk about super exciting, the rollout that you have with First Horizon on the medical professional loan. For our listeners that are familiar with you and with First Horizon, we've been talking for years about the Pharmacist home loan product, which is, if folks are familiar with kind of the doctor loan concept, it's one of the more niche products that are out there that allows strong earning, typically high credit medical professionals. These often started with physicians. Some of these products expanded to pharmacists to be able to purchase a home with less than 20% down without incurring PMI or private mortgage insurance. And the Pharmacist home loan product has been a great option for many pharmacists. Available in the lower 48 nationwide. That product is still available, 3% down for first-time home buyers that have credit scores north of 700. No PMI in that product. So great option. But now we have the medical professional loan, which is available to a suite of healthcare professionals, MD, DOs, dentists, but includes pharmacists now as well. And this is really exciting because it even further expands the opportunities, I think, for pharmacists when it comes to financing a home purchase in the midst of all the other goals that they have available to them. So introduce this product, this offering to our audience and some of the highlights of what it offers.
Yeah, we're super excited to be able to offer this product. I think it's going to be a big help to a lot of folks. And basically, it's going to allow 100% financing up to $2 million loan amount. So there are some credit score constraints for $2 million, but at a 680 credit score, you can go to $1.5 million with zero down payment, no PMI. And with a 720 credit score, you can go all the way up to $2 million. So it's just going to allow a lot of flexibility, the ability to put very little down, not have PMI. We traditionally offered it only to MDs and DOs, and now we're including all these other professionals, including pharmacists. So it's very exciting. We can offer it in 48 states, so it'll be very flexible, Tim, as far as our offerings. We've got a couple different products. Some are isolated to just certain states, but this one we can go, the lower 48. It's going to encompass fixed rate products, 15-year fixed, 20-year, 25, 30-year fixed. Also ARMs, 5-year, 7, 10-year ARM. So there's going to be the ability to look at both fixed rate and ARM products for our clients. And that's really exciting. So I think it's going to be, we just rolled it out, within the last few weeks. So it's, kind of fresh off the print here, but we're getting accustomed to the guidelines and starting to pre-approve some people. So it's been really, really fun. And I'm very, very fortunate to be able to have this offering. So I'm excited to help some folks with it this year.
I'm going to hit the highlights again, just to repeat that back
Yeah.
to our listeners. So this is First Horizon's medical professional loan product that includes pharmacists. So 100% financing up to $2 million loan amount, no PMI. There's fixed and ARM options available, as you mentioned, and available in the 48 lower states. So that would reach most of our audience, and some specific credit and reserve requirements that would be involved in that as well. So just a great opportunity, I think, for, again, all the reasons we've talked about, whether it's a first-time home buyer or not, coming up with a sizable down payment in today's market and today's home values is a challenge. I remember, Tony, when I bought my first home, Jess and I, in 2000, it should have been what, 2011? Yes, 2011. We bought a 4-bedroom house for $176,500. And it's funny how you never forget that number right on your first home. And, I remember specifically just what was required of that in terms of down payment. And, that market just doesn't exist in 2026, and even in Ohio, if you were looking for a 4-bedroom house, regardless of really what part of the state, let alone other states in higher cost of living area, you're looking at home prices that have appreciated significantly, and therefore the down payment and the reserves that are needed there as well. So we continue to see a lot of pharmacists who have the aspiration and goals of purchasing a home, but because of the competing priorities and other things that are going on in the financial plan, coming up with that large down payment can be a challenge. And so I think products like this, excited to see pharmacists included in these types of products, is an exciting opportunity that's out there. So Tony, as we wrap up, as always, great stuff. Love having you on the show. Always appreciate your perspective and the value that you bring to our listeners. Let me ask you this as we finish, and we'll certainly link in the show notes to more information on this product. We'll link to your page on the First Horizon website as well. What is the best place that individuals can go in terms of getting in touch with you, and especially if they're interested in learning more about this product and offering?
Sure. My office line is a great way to catch me. And we could list that, our main office line, my email address as well.
Okay.
I'm happy to, respond to emails, and then, calls as well. So we can always set up a time to talk. And, I have a great team here. I'm very fortunate. Just really good people on my team. So, they can set times for us to chat about the product. They're very capable to chat about it as well, not just me.
Okay.
So we're well covered, but yes, direct calls or emails are fine.
Okay. Awesome. We'll link to those in the show notes for those that are itching to get that right away. Email is tony.umholtz. That's UMHOLTZ at firsthorizon.com, or the office line is 813-603-4255. So Tony, great stuff. And again, really, really appreciate your perspective and having you on the show.
Tim, thanks for having me. Had a great time here. It's always good to see you. So thanks for
You too.
the time here.
You too. Take care, Tony.